As you might have deduced from Nikki's presentation, of course, property does not operate in a vacuum. So, and South Africa doesn't operate in a vacuum either. So, you will excuse me if I'm going to repeat some of the stuff that Nikki said. And because she agrees with me, she must be very clever. Right, world prospects, the developed world must be leveraged. Please, I'm not thinking about next year, I'm thinking about the next 5 to 10 years. Because we are into property, we're not into shares, equity, and this can take a long time. Now, you can have a contract review, of course, but that's more or less how my mind works. Right, the medium-term prospects for the SA economy as a result, and lower growth in the wake of low world growth and infrastructure constraints in South Africa, including the Eskom debacle, right? Already mentioned, taxes and tariffs set to rise to catch up with backlogs. The fiscus is in the corner. Consumers are highly indebted, thus disposable income under pressure. I think that's more or less, that's what he could have said in one slide. Okay, normally I don't quote other people because it implies that I can't think for myself, but I thought this was such a good quote, I couldn't read. Resisted. Chris Hart in the business day said the other day, the credit-based consumption-led growth model has reached a dead end. I think that sums up what Nikki was saying. Right, all our forecasts that I'll show you in my presentation are based on 2 scenarios. The first scenario is the base scenario. This we get from every 6 months we do a survey amongst some of the top economists in the country, and we ask them for their 5-year forecast, and this is their latest one as in June. It's still on the high side for my liking. But I mean, that is already too high. I think the Reserve Bank's latest figure is 1.5, their best estimate, 2.9. I think that is more or less what Nikki was also forecasting. In other words, yes, we are going through a tough period at the moment, but we are back to a normal sort of cycle from 2016 onwards. That's more or less what these forecasts are saying. I have my serious doubts about it because of that. For the past 2 years already, we've had a 2% GDP growth scenario, just to see what is the worst case. Compare the worst case with the baseline. Right. Oops. Next. Right. First of all, a lecture on the long property cycle. Those of you who are have religiously come to my presentations over the past few years have seen this before, I know, but from my experience, it takes a few years to understand it. So. The theory behind property values is that in the long run, property values are driven by replacement cost, which is a fancy word for building cost, and in the very long run, building costs grow at more or less the same rate as the CPI, right? Normal consumer inflation. And then around that trend, along that trend line, that's the trend line of building costs. Along that trend line, you've got the oscillation effect of rentals or values. And the oscillation, of course, is created by demand and supply that are changing over the cycle. Right? When you are up here, when you are up there, developers start piling new supply onto the market, and of course then you oversupply the market, and here you are in the depths of despondency, and you want to emigrate, and you want to migrate your funds out of South Africa, and things like that, and so forth and so on. If you take that top graph and you divide the rental, that oscillating rental or value, and you divide it by the long-term growth rate, which is the inflation rate, then you get your real cycle. The important thing about that real cycle at the bottom of the graph is that it only works, this model only works where you have a free market where you can constantly add new supply to the existing stock of houses or office buildings or whatever the case may be. Where it doesn't seem to work is places like London, where you've got a very strict constraint on the supply side. but where the demand keeps on growing. So that's why London has been one of the very best investment opportunities in the world over the past number of years. Another example in South Africa would be the Cape Town's Atlantic seaboard. God doesn't make any more land, so your supply side is very constricted, but demand keeps on growing as all these playboys come to South Africa. Right, another important point to note from this graph is that in the long run, in real terms, property prices move sideways. But there's a qualification to that statement. It only applies to an artificial portfolio which is constantly being renewed, either by spending a lot of money on refurbishments, or by selling off older properties and buying in new properties. So it's a bit artificial. For any individual property or building that ages, like everything in this universe is down, and therefore for an individual property, that trend line wouldn't be sideways, it would be down like that. Right? Important thing to remember. Now, does this mean that property is a poor inflation hedge? The answer is no. This brings me to what actually happened in South Africa. Empirical evidence, and what you're looking at is the broken red line is office rentals in Durban. Up to 1982, it was the CBD of Durban, and thereafter it was decentralized office space in Durban, like Sandton. And the blue line is house prices. Most deflated using the BER building cost index, in other words, replacement cost. Once again, as you would expect in theory, yeah, interestingly enough, moving sideways, right? Exactly as you would expect. But of course, this is artificial because we're using prime office rentals, and we are using housing stock, which doesn't age by much because we all, after 20 years or so, or 30 years, we renew our houses, and new houses are being built and added to the stock, and old houses are demolished and things like that happen. So it doesn't, once again, reflect necessarily a single or individual property over time. Right, during periods like this, of course, the upside, as I said, then new supply is being added, unless, of course, the banks go on strike as they have been over the past number of years, and then it will change the trend. You'll note that offices and house prices, they moved more or less in sync for many, many years. And note how long this cycle is. Note how long this cycle is. It's 1960, 1977, 1995, and so on. About 15 to 20 years. And just in South Africa, you have this phenomenon. It's more or less a worldwide phenomenon. We have free markets, and let's not go into the reasons for this very long cycle. But I recently read a book by an academic in the UK. He did research on a construction cycle, building construction cycle in the UK going back 200 years. And guess what? We came to the same conclusion, 15 to 20 years cycle. So, yeah. So the practical implication, of course, is if you're only going to rely on the cycle to make money in property, then you've got twice the opportunity in your working life to buy property very cheaply, and you've got twice the opportunity to buy very expensively. It's up to you to choose. The only way to choose is by regularly attending the Rode conferences. And that's why I show these graphs every year. Now then, you'll notice that a funny thing happens on the way to Durban. In about the year 2000, the two graphs, the two lines start to company. The question is why? My theory is that you might recall, as Vicky was telling us, we've got inflation under control through very high interest rates, and as interest rates came structurally down in the footsteps of the lower inflation, it benefited affordability of houses more than than office buildings, which are not as sensitive to interest rates. In fact, non-residential property is very insensitive to interest rates. There is very little correlation between the capitalization rates of non-residential properties and interest rates. Right, so you have this hurrah there, and the question is, where did this hurrah come from? As I said, most probably it was only interest rates that created that. There was at one stage a theory out there that after 1994, you knew black middle class were moving into the suburbs, and that might have created extra demand. My argument was that there was an equal number of whites emigrated at that stage. About 1 million was a figure that was bandied about at one stage, nobody can verify it. Thereby cancelling one another probably out. Be it as it may, that the research that we have done comparing our little boomlet here, bubble, with the American bubble, was that ours was even worse than the American bubble. I haven't got that graph here today, but just to let you know that we are compared with America from time to time, not bad. Gee, this is a complicated. Right. For the fun, I'm showing you there house prices in one of the poshest streets in the world, more specifically the Herengracht in Amsterdam. And what's so wonderful about the Herengracht, in the year 1628 AD, right? Yeah, AD. 1628 AD, the Herengracht was a posh street, residential street in Amsterdam. It's still neat. Now, you don't have scientific measurement possibility like that in many parts of the world, do you? And what it shows is real house prices in the Herengracht from 1628. That's a few years before Jan van Riebeeck landed here, by the way. Well, he didn't land here, landed in Cape Town. And note the long cycles. Because this is from 1628, this is actually, the cycles are very much compressed now, but you can see there are many cycles and cycles and cycles. And some of these cycles are very, very long. So don't be surprised when we talk about long cycles. As a matter of interest, what you'll notice here is the VOC, Verenigde Campagne, the Dutch East India Company, was the first international trading company in the world. And National Hunting Company from Amsterdam, with trading with what we now call Indonesia, Jakarta, those places. And it took you about 7 months to send the ship to Jakarta, and 7 months back if you came back. How do you run a company like that? By doing this thing. Anyway, it was the most important source of revenue for the Netherlands, the VOC. It was dominant, absolutely dominant, as Anglo-American was in South Africa 50 years ago. And even worse, or better. And so when it collapsed, when the company collapsed in 1795, which happens to be the year when the first British occupation of the Cape took place, yeah, then it was still not British, it was then still, it was before the Union, so it was English. Yeah. I learned all this history recently, what the Scottish thing. Right. And you can see this in this graph, how the Dutch economy was devastated through the Napoleonic Wars and after the demise of the VOC. You can actually read a country's history by looking at this graph, economic history. And so what it shows us is this interdependence of property and the economy. Real United States house values. To prove my point, what you'll see here is from 1950, house prices in the real terms in the United States moved in a channel. On this scale, the channel was between 80 and 100 from 1950. Moving little, not little, these were actually very big cycles. And the scale that you think they're not big, right? In real terms, please note. And then something strange happened. All of a sudden, here around about 1998, thereabouts, house prices just shot through the roof in the USA. And the question is why? And why didn't anybody see it? So there was one guy who saw it, but nobody would listen. The easy answer, of course, is easy money, low interest rates, zero interest rates type of stuff. It was made possible to cheap imports from the east. And as one economist wrote, it's a strange way to run a world economy or a country's economy. Consumers use their mortgage bonds as ATMs to withdraw more and more money from their mortgage bonds and to spend it on Asian goods. And yeah, so no small wonder it had to implode. You can see now they've had a correction of some sorts, a very, very sharp correction, but they haven't actually come back to that bottom. So I'm a bit hesitant to say this is the bottom. Who knows? Here's South Africa. You can see our downside here was much worse than the Americans. But of course, in our case, it was two things. It was the interest rates that went so high to fight inflation, number one. And number two, of course, it was the political transition. And then we had this huge recovery. But the important point is that we haven't come back. We haven't had a decent correction. That will still happen. My forecast is that that correction will happen over time. It's not going to be a overnight affair like the Americans had. But it does imply that as prices come down in real terms over many years, is that house prices are probably not going to keep up with inflation for a very long time to come. But returns. We're all here for returns, not so. We're not here for the fun of it, because some people think it's great fun to lose money on property. I think it's all about returns. Just to give you a feel for listed properties performance, as I explained to you, you can show anything with figures when you choose your period. So in order to be honest with you guys, I used a long cycle starting in 1995 to 2013 to give you listed funds, total returns, mostly geared in South Africa. And you can see the real total return was 15%. Amazing. Once in a lifetime sort of return. Compared to an inflation rate of only 6%. As for directly held properties, now what you're looking at here is institutionally held, directly held properties. So they're not listed. And of course, bear in mind that especially during this period here, the institutions started actually trading, not trading, but they were sort of selling off their lemons and buying in new properties. They started trading. But up to that point, up to 1995 and earlier, those two cycles, from 1962 to 1995, the typical strategy of institutional property landlords was the so-called naive buy and hold strategy. You would buy and you would hold. I'll never forget, I once said to a colleague of mine at such an institution, just many years back, I said, but given where we are in a cycle, why don't you sell this property in the CBD of Cape Town? And his answer was, I can't, because we'll never be able to buy back again. So you see, it's a completely different way of looking at an asset compared to, say, equity investors. Don't bring emotion into investing in property or any asset for that matter, unless it's a wife or something like that. Oh, by the way, yeah, the important point here is that you'll notice for normal cycles like those two cycles were, expected real total return is about 4 to 5%. That's the international rule of thumb. But if buy and hold strategy, you never sell, you do maintain, of course, your property. But that's the total returns that you can expect in a real term. And of course, total return means income yield plus capital appreciation. Right? residential property. I thought I would show you this. We're looking at residential rentals in Durban. We're comparing, we indexed everything to 2005, and we're looking at rentals for flats, houses, and townhouses. You'll notice that houses performed best over that period, house rentals, right? Performed best, but there's very little growth left now. In fact, houses at the moment grew only at about 1% per annum, which is another indication that the consumer out there is under huge, huge pressure. It corroborates what Nikki has been saying. The second best performer was townhouses, but you can see they are also under stress, and of course that's where most of the new supply is being added. So it's security complexes, not so. So on the supply side, a lot of it is being added, the little that is added. And then of course the worst performer, it was flats, which is quite amazing to me. In the other cities, flats were the worst performer. I suspect what's been happening here, that the weight of flats in the CBD is probably greater in Durban than in other cities, right? And one suspects that one could go into this, but I think that's the explanation why flats get so good in Durban. What you're looking at is the real value of new mortgage loans and readvancements from 78 in South Africa. Please, it is real. So you can see here from about 1992, thereabouts, as the new South Africa started going, we had this tremendous growth. That, of course, coincided with lower interest rates and so on. But that is evidently a bubble. So I would say the trend line should be more something like that. We built a model to forecast for those of you who are, whose income is somehow linked to either estate agency, linked to the number of the churn in the property market, right? So it's estate agents, conveyancers, valuers, home valuers, and people like that. We built this little model to forecast mortgage loans, granted, which is a proxy for number of sales in a way. And you'll see our model shows that there's actually going to be very little growth over the next few years. Please note this is in nominal values, so if you deduct inflation, then it's actually mostly just about below inflation or something like that. So we're not forecasting a lot of churn happening over the next few years. What is an unknown factor, and which is not in our model, which Nikki alluded to, is the possibility that the banks will start loosening their credit criteria. Right. That's the unknown factor. We've built this on the assumption that the banks are not going to change their lending criteria. So let's hope it's going to happen, because if that is going to happen, if the banks are going to loosen their credit criteria, then of course it will make it more possible for developers to start building houses again, and that will put some pressure on the supply side, of course, and that would be good for everybody in the market. Right, so to sum up, medium-term prospects for house prices. Prices are still very high in real terms, so there is downside potential in real terms, I'm afraid. Consumers are under lending stress. Interest rates will rise for two reasons. Okay, that was already covered by Nikki. I've got Basel III here. As I understand the Basel II and III, Nikki, correct me if I'm wrong, is that the banks must try to match their assets and their liabilities on their balance sheet. And the problem with a mortgage bond is it's a 20-year bond, and that is on the asset side of their balance sheet. And on the liability side, they've got you and me over 6 months and 1 year deposits. Right. So it creates a huge problem for them from a risk point of view, from a balancing of the terms of the assets and liabilities. And that's why they're not all that fond of home mortgage bonds. Apart from the fact that, from what I understand, is their profit margin on the mortgage bonds is also on the third side. Do you more or less agree with that statement, Nikki?
Yeah, but it was a function of price. So in the previous cycle, the price was very low, and then the rules changed with Basel III, and then government has also now introduced the Reserve Bank Intervention Fund, which will make it possible for South African banks to meet the liquidity ratios under Basel III. So it takes a bit of the pressure off in terms of the mortgages, and it makes mortgages a more attractive business altogether for banks because of those changes.
Thank you. I hope you heard that one. Right. Good. Thus, prices will revert to the mean in the medium term. It can take a long term, medium term is a very flexible term. But there's no doubt about it. Prices will revert to the mean. It's a question of time. And the most important lesson one can learn from this is that in the past, house investors based their forecast on significant capital growth. If you take the capital growth out of the equation, then a house investment is a very poor investment. I mean, what do you get if you were to buy a house now, buy to rent? Net return maybe for a 3-bedroom house maybe is 5-6% maximum net return, not gross but net. And how much does your mortgage bond cost you? 9%, 10%? No? You can see immediately you are in negative cash flow territory, right, to start off with. So to offset that, you need significant capital growth. And if you're not going to get it, then of course, a leveraged house as an investment becomes a poor investment. It's as simple as that. I've run the figures in Excel, it is true. Right, shopping centres. I'm afraid here's some more bad news. Over the past 40 or 50 years, shopping centres have been the best property sector to have invested in. It's as simple as that. And of course, as Nikki explained, South Africans are very good at shopping. It's our competitive strength out there in the world, and that's why shopping centres have been such a good investment. Now, to check how healthy our shopping centres are, I did a few calculations. The data comes from IPD. I did the calculations, so if they're wrong, it's my fault, not theirs. You'll see over the period 2003 to 2013, which is about 11 years, super regional shopping centres had a trading density growth rate in nominal rands of 8.2, which is just slightly above the inflation rate, which is not too bad. Right? Trading densities are turnovers per square meter of the retailers within the mall, right, in the shopping centres. As property people, you probably know that. Compared to the smaller shopping centres called regional shopping centres, where it was more or less right spot on the inflation rate. Compared to small regional, where it was less than the inflation rate, over that 10-11-year period. Over the past year, the same trend was visible, except that the growth rates of especially the small regionals has dropped quite considerably, and that substantiates in theory I've had for a long time that these in-between shopping centres are the worst performers. They're neither fish nor flesh. What do you say? Not a fish, no? Fowl, not fowl. So Afrikaans is not fish nor flesh. Right. Right, so it looks like the bigger shopping centres are still okay, although my information is that even the bigger ones are under some stress, given what Nikki was explaining to us. Now the question is, as you guys know, one of the big problems that shopping centres face is not so much that the turnovers per square meter are under stress, which they are. The biggest problem is operating costs that are going wild. And the culprits there are assessment rates and electricity, and to a lesser extent wages. They can control wages to a degree, of course, but your biggest problem is assessment rates, payable to the municipalities, and of course electricity, which is an Eskom problem. Now, So I did some research a few months ago, and I went directly to the municipalities concerned, 4 metros. In the end, I got data that I could use for 3 metros to find out why are the assessment rates for non-residential properties rising so fast. As you may know, Zimbabwe is up in arms about it. It's a big issue. Really, it is a big issue. And here's mine. Here are the results. Salary bill by meter, and this is exactly what Vicky was saying. I'm just hearing in municipalities now. Salary bill by meter. Compound growth rate per annum for 10-year period. Right, the past 10 years. 80-20, 30% compound salary bill compared to inflation of 6%. And the others the same. City of Cape Town, which we all think is very well run, 14% compound growth rate. That's why I'm losing my best people to City of Cape Town. And it's exactly what Vicky was saying, but on a higher level. And this is very high salary hikes and appointing new people. In the case of 80-20, I noticed there strategy seems to be to appoint many new bums. Sorry, you know, things that sit on chairs. Not necessarily is the problem the sharp rising in salaries, but more the number of people that have been appointed in the lower echelons. That seems to be, that's my interpretation of the figures. But so it's quite, I found it quite interesting that you came up with very similar conclusions, but on a higher level. Right, completion of new malls. We are all worried about the number of new malls being completed. So we compiled the stock of new malls from 1960. These are essentially only decentralized malls. There are very few city center malls in there. And these are new completions. In other words, you could, in a way, you could look at it as the first difference in the stock, right? Year by year, new completions. And as you would expect, it is volatile because we're talking about big shopping centers being thrown into the stock from time to time. The red line is from Stats SA, and to check whether our figures are believable. And yes, there's quite a good correlation between the two, except that there's lag a little bit, and there's a technical reason why Stats SA is data on the next slide. Right, now to find out whether we've been over-shopping our country over the past number of decades, we did a calculation of the new completions of shopping centres since 1987, there we are, and since 1995. And we compared those growth rates with the real household consumption expenditure and with real GDP. And you can see for both periods, the more completions weren't that outrageous given the huge growth in consumption expenditure that we've had. I think as of late, in the shorter period, over the past year or two, three, and for the next few years, that probably wouldn't look as rosy in certain places where huge new shopping centers are still being built, whereas the economy is going in stagnation. Okay, growth in retail sales, I'm not going to spend much time on it, excepting I would like to point out that the growth is coming down in the real term. Thank you. Offices. Here's an interesting one. If you come to think of it, what would drive the take-up of office space? The answer is, of course, the services center of GDP, at which the guys who sit behind computer screens and make us all believe that they're actually working, people like us. That is what drives office space, the take-up of office space, not so one thing. And during that exercise, you'll notice that the red broken line is GDP services sector. That's, in other words, the guys who typically sit behind computer screens, compared with the actual square meter take-up of office space. nationally in South Africa. And you'll notice, and this is the scary one, that there's a zero line, that from 2008 we've had negative growth in office take-up in this country because of what we see there. Right. Now, we've all heard about this shift in the world economy. More and more people are working in the services sectors, and fewer are into manufacturing and so forth and so on. If your tertiary sector is slowing down, then you must know you've got a serious problem. However, there is some good news. Office vacancies are more or less at the long-term average. Right, so all we are doing really is we are waiting for this. We're waiting for Badoo. We're waiting for this magical upturn that economists keep on pushing out 2 years or so. Right, rentals, I'm not going to waste time on it. As you will see, the national decentralized and Durban decentralized are keeping pace more or less, so that's good news for Durban. You're not falling behind. Here's the scenarios. Comparing both are for Durban. What we're looking at is, here's the base case scenario, average 2.6% growth. That is the sort of normal growth we could then expect in office rentals in Durban, decentralized, compared with the 2% state growth rate per annum, where those growth rates are more or less half. It's still reasonable, you know, if you come to think of it, it could be much worse. Right, industrial property, very similar situation. But note here that Durban has actually been doing very well. Thank you very much. Durban industrial rentals are actually outperforming, or have been outperforming, the national industrial rentals for a long time. So that's quite good going. I can't offer an explanation for this. Maybe all the imports going through Durban Harbour, since we are consuming so much. Once again, growth rates under the two scenarios. 9% there, half under the 2% scenario. Once again, not too bad. Listed funds, I'm not going to spend time on it unless there's a clamour from the audience that I should spend time on the listed funds because I'm running out of time. But I'm going to say the following. Why our REITs or listed funds have been doing so well over the past 12 years or so, and here's my claim. The debt leverage because of the low interest rates has been positive, and of course the strong market rating, in other words low income yield, which allowed funds to buy directly our portfolios at earnings enhancing yields. And then lastly, some funds have been investing offshore. So those are my explanations why the listed funds have been doing so well. The question is, how long can this virtuous cycle last when interest rates start rising? And I'm afraid, I think the tipping point will be very soon, just in a year or so, the positive gearing will disappear, and then this will have then the virtuous cycle might just become a negative cycle. Right. By the way, I'm not going to bother you much with these two graphs, but what these two tables do show is that the expected total returns according to our modeling for listed funds is in the early 10% total returns, 10, 11, 12% over the next few years, compared to about 8% or so total return in terms of the 2% scenario. Capitalization rates. That's the best way to measure the health of properties in South Africa is by comparing comparing over time our capitalization rates. Declining capitalization rates, of course, are good news. It means that the investment market out there is positive about the future of unlisted property in South Africa. And as you can see, yes, as of late, there's been cap rates have been sliding down, ever so lightly, but they are going down, which is a very good sign. It means that we've got lots of confidence in property as an investment in South Africa. So, conclusions. World economy and infrastructure backlogs are constrained on SA economic growth. Residential property is still overpriced, so don't expect much capital growth from a residential property. Office properties are fundamentally cheap, but vacancies persist. Industrial properties are fundamentally cheap. Highly indebted consumers face challenges, plus more cash flows will remain under pressure, especially more in working class locations. I think we also made that point. Property market is fundamentally healthy now, and I think analysts are unreasonably pessimistic about it based on our consensus macro forecast, and considering what is the alternative. You know, one of the alternatives is to invest overseas in property.